Hello and welcome to our Vietnam Today show on viewv.vn. Vietnam is successfully weathered the COVID-19 crisis and other external risks such as global economic recession, rising inflation, the Russia-Ukraine conflict to secure high economic growth. Meanwhile, the global economy is facing the risk of recession with inflation rates in major economies such as the UK, US and EU reaching their highest levels in a decade. In today's show, we have invited Andrew Jeffries, ADB Country Director for Vietnam, to come to our studio to shed light on the Vietnam case. Hello, Mr. Andrew Jeffries, the ADB Country Director for Vietnam.
Hello, Mr. Bing, and hello to readers of VOV.vn.
As you know, Vietnam's GDP expanded by 5% in the first quarter and 7.7% in the second quarter, despite the external risks such as the pandemic fallout, the rising inflation, then the Ukraine-Russia conflict. Do you think that the measures adopted by the government have proved effective, helping the economy cushion the impact of those factors?
Yes, I think what the government has done has been remarkably effective. Going back a little in time, let's start with handling the COVID-19 pandemic relatively well. And last year's aggressive vaccination campaign has allowed a more flexible approach and a return to economic normalcy that is paying dividends this year. The government has also had a tricky situation with these global shocks you mentioned, inflation, the Russian invasion of Ukraine, supply chain issues, and they've managed to keep monetary and fiscal policies supportive for economic growth, have kept the Vietnam Dong relatively stable. Inflation is relatively low in Vietnam compared to many other places. And there's still an economic recovery and development program in place to still try to give recovery to businesses that had a hard time over the last 2 years. So doing all of this is a tight balancing act. And so I think the State Bank of Vietnam should be congratulated for what they've done.
Okay, so what is the ADB forecast on Vietnam economic growth this year and next year? And what prompted the bank to come up with this forecast?
Back in April, we forecasted 6.5% GDP growth for this year and 6.7% for next year. And in our recent update, we kept the same levels. The reason for this is we've seen a very strong rebound this year economically. Manufacturing and industrial activity has gone up. Domestic consumption is up considerably from last year, including a big uptick. Domestic tourism is more than it was before the pandemic. And we're starting to see international tourism slowly reemerge. So these have really helped the service sector. And the banking and financial sector has also seen good growth this year. So these are all factors that have contributed to our assessment. I note other organizations have increased their outlook recently to higher than ours. We've decided to maintain ours at 6.5% due to just some of the global risks out there. But we see further growth next year, so Vietnam is clearly back on its pre-pandemic high growth levels.
As far as we know, that not only the Asian Development Bank, but also major global financial institutions such as the World Bank, the International Monetary Fund, have projected a positive outlook for Vietnam's economy this year, which is likely to grow between 6.5 or 7%. It seems as if that Vietnam's economic growth is in contrast to the recession trend as recorded in major economies in the world, such as the UK, the US, or in China. So, do you think that it is an exceptional case for Vietnam?
somewhat exceptional. I mean, we see Vietnam's 6.5% growth, and I know the IMF recently projected 7% for this year. That is clearly one of the highest growth rates in Asia. But developing Asia overall, we do see economic growth this year. Our outlook recently downgraded it for the region a little bit due to these global economic shocks occurring. But I think developing Asia still is around 4.3 or 4.5% growth this year as a whole. Vietnam is therefore, clearly on the on the higher end of growth, and is actually pulling up the regional average rather than pulling it down, which some other more struggling economies are doing.
So what are the major challenges facing Vietnam's economy in the remaining months of the year, you think, and how will they affect the country's economy?
I think the continuing economic shocks from the monetary tightening that's going on by the US Federal Reserve, the European Central Bank, and other economies is a challenge for developing countries in general. It's causing capital outflows. It's causing currencies to depreciate, which means that importing goods, including fuel, which has experienced a very global price surge this year, become even more expensive, therefore exacerbating inflationary pressures. So the biggest risks for Vietnam are, one, this global phenomenon that could impede inflation in Vietnam. It could support more inflation in Vietnam, particularly for imported goods that are needed and inputs for final manufacturing and export for Vietnam. Also, a big risk is economic recession in the US or the EU or elsewhere, because those are large export markets for Vietnam. And so that's a clearly risk for Vietnam's open export-oriented economy. That's not to say it's going to happen. Despite the aggressive rate increases and high inflation in the US, the economy in the US has held up reasonably well. Vietnam exports to the US are up 33% this year. So it's not quite sure whether this aggressive action from the US Federal Reserve will tip the US economy into recession or just slow it and tame inflation. But clearly the risk to the demand for Vietnam's exports is probably the immediate concern.
The government said that it's hard to contain inflation at 4% this year. An ADB forecast for Vietnam's inflation at 3.8% for this year and 4% for next year. The State Bank of Vietnam recently decided to raise interest rates, a move believed to control inflation and maintain the macroeconomic stability. Why do you think that Vietnam decided to adjust its interest rate policy at this time of the year, not earlier, and how it will affect the government's effort to keep the inflation in check?
As I mentioned earlier, the authorities here in Vietnam and the State Bank of Vietnam has a very delicate balancing act, trying to curb the inflation, which is a cost push inflation caused from global external factors, not from an overheating domestic economy, while at the same time trying to push recovery from the pandemic and the increased domestic investment and credit for businesses is important for their recovery, but that also could contribute to inflation. So it's quite a difficult balancing act, and up until now, they've done a very good job managing credit growth by quantitative limits on credit growth, and also they've maintained a stable Vietnam dong. But such aggressive monetary tightening in the US and EU and elsewhere, including very recent hikes, has caused them to take a quite aggressive, decisive action and raise rates by 1 percentage point here in Vietnam. Again, this is to keep the dong stable and tame inflation. And it's a decisive move and should help to keep inflation stable and keep the dong stable in Vietnam.
Okay, right. You see that foreign trade plays an important role in Vietnam's economy. Amid increased uncertainties in the global economy, Vietnam has had constantly a trade surplus over the past months, but is on the downward trend. So is it worrying that the trade of the country, given its large openness, will suffer from spillover effect of the global economic recession?
This is definitely a concern for Vietnam. As I mentioned earlier, possible recession in the US or elsewhere. These are large export markets for Vietnam and could thus negatively affect Vietnam's exports. Also, global inflation means that imports from the rest of the world could be more expensive. So if exports slow down and imports become more expensive, that definitely affects Vietnam's overall trade balance. So what firms need to think about is, and this is more of a longer term solution than an immediate solution for the rest of this year, is how to diversify export markets so that a slowdown in one part of the world or one large economy, there's still export opportunities in other parts of the world or other economies. Other things to consider are just continued long-term support for the economy, for maintaining macroeconomic stability and increasing Vietnam's competitiveness to further support industrial activity and exports going forward. But in the immediate near term, there's not a lot that can be done by the authorities other than what they're already doing.
So talking about the FDI attraction in Vietnam, which is a part and parcel of the economy. So statistics show that the Vietnam has attracted more than 12.8 billion US dollars in the first 8 months of the year, about the 10.5% year-on-year increase. So will this upward trend be maintained in the remaining months of the year? And what should Vietnam do to attract more high-quality FDI?
I think there's a lot of near-term concern about capital flight because of the rate increases in the advanced economies that's causing some portfolio investment to leave emerging and developing country markets. But that's different than foreign direct investment. FDI is long-term money. It takes years for FDI international companies to make decisions and make investments in Vietnam, construct their facilities, and reach operation and manufacturing and activities. And FDI is thus not something that will flee because of immediate external shocks. In fact, slowdowns in Europe and elsewhere may actually accelerate the decision to move some FDI to Vietnam, given Vietnam's long-term attractiveness for FDI. Remember that Vietnam is part of ASEAN. Investing in Vietnam gives investors access not just to Vietnam's market, but to all of ASEAN. There's a growing middle class with more purchasing power in Vietnam. So Vietnam is becoming an attractive market in and of itself, not just an attractive destination for manufacturing for export elsewhere. And lastly, Vietnam has done a remarkable job maintaining sound economic fundamentals and stability, and these are all important for FDI investors. So long-term Continued activity to continue to attract FDI would include continuing to improve the business environment, streamline administrative procedures and lower transaction costs. Also continue to build out the country's infrastructure so that ports, airports, intermodal transport, roads and interconnectivity continues to grow and improve. Energy and power supply need to keep up with the fast demand. And lastly, another important point to consider to keep Vietnam as a competitive FDI destination is to follow through on Vietnam's impressive net zero carbon emissions commitments made last year. The reason I say this is because a lot of FDI investors have their own carbon commitments to make. And so when choosing a country or location to invest in, an important consideration is access to clean and renewable energy in those destinations. So not only that, but as an exporting country, consumers globally are starting to pay more attention to the carbon footprint of the products they buy. And there's risks to exports from border carbon taxes. So the decarbonization and energy transition that's required in Vietnam and actually throughout the world is important for Vietnam's competitiveness as an FDI destination as well.
So thank you very much for your in-depth analysis about the situation in Vietnam. Thank you very much for your watching and hope to see you next time in another show on ViewV.vn.